The man who bet $10 billion that an entire country was lying, broke the Bank of England, and made $1 billion in a single day while bringing a government to its knees. On September 16, 1992, a Wednesday that would forever be known as Black Wednesday, while the British government was desperately trying to save the pound sterling from collapse, while the Chancellor of the Exchequer was holding emergency meetings, and the Bank of England was burning through billions of pounds of foreign currency reserves trying to defend the national currency, while interest rates were being raised from 10% to 12% and then to 15% in a single day, in an unprecedented act of monetary desperation, while the entire British financial system was teetering on the edge of catastrophe and the Prime Minister was facing the biggest crisis of his career, one man sat in his office in New York City, watching it all unfold exactly as he had predicted. And that man was George Soros, a 62-year-old Hungarian-American hedge fund manager who had just executed the most audacious, most profitable, most legendary currency trade in history, a trade so massive and so perfectly timed that it would earn him over $1 billion in profit in a single day, would force Britain to withdraw from the European exchange rate mechanism in humiliation, would cause the resignation of government officials, would be studied in every finance and economics class for the next 3 decades, and would forever cement Soros's reputation as the man who broke the Bank of England, a title that, depending on who you ask, makes him either a brilliant financial genius who exposed the flaws in a broken monetary system, or a ruthless speculator who attacked a nation's currency for personal profit and caused suffering for millions of ordinary British citizens. But regardless of which interpretation you prefer, everyone agrees on one fundamental truth. George Soros looked at the British government's promises to defend the pound, analyzed the mathematics of the situation, concluded that Britain was either lying or delusional, bet $10 billion that he was right and they were wrong, and then sat back and watched as the entire British establishment proved him correct by collapsing in spectacular fashion. And in doing so, he didn't just make a fortune. He demonstrated something profound and terrifying about modern financial markets, which is that no government, no matter how powerful, no matter how many reserves it holds, no matter how much it protests and threatens and promises, can ultimately defeat the combined force of global capital markets if the mathematics don't work, if the economic fundamentals are wrong, if the policy is unsustainable. The market will eventually win. And when it wins catastrophically, and someone like George Soros will be there to profit from that catastrophe. Let me take you back to understand how we got to Black Wednesday, because this story doesn't start in September 1992. It starts years earlier with Britain's complicated relationship with Europe, and with a monetary system that was doomed from the beginning. The European Exchange Rate Mechanism, the ERM, was created in 1979 as a precursor to the eventual creation of the euro. And the idea was simple in theory, but nightmarishly complex in practice. Member countries would agree to keep their currencies trading within narrow bands against each other, specifically within 2.25% above or below a central rate. And if a currency started to move outside those bands, the country would have to intervene, would have to either buy or sell currency to push it back into the acceptable range. And the theory was that this would create stability, would force countries to coordinate their economic policies, would eliminate competitive devaluations, and create the conditions for a unified European market. But the reality was that different European countries had wildly different economies, different inflation rates, different growth rates, different political pressures, and trying to force all their currencies to move in lockstep was like trying to harness horses running at different speeds to the same cart. Eventually, something had to break. Britain had resisted joining the ERM for years. Margaret Thatcher was deeply skeptical of anything that constrained British sovereignty, saw the ERM as a German plot to dominate European monetary policy, and she was partly right. Germany's Bundesbank was the most powerful and most conservative central bank in Europe, and the ERM effectively meant that other countries had to follow German monetary policy, whether they liked it or not. But by 1990, pressure was building on Britain to join. Political pressure from pro-European factions within the Conservative Party, economic pressure from businesses that wanted exchange rate stability, and strategic pressure from the logic that Britain needed to be at the table when European integration was being decided. And so, on October 8th, 1990, Britain joined the ERM, entering at a rate of 2.95 Deutsche Marks to the pound. And immediately there were concerns that this rate was too high, that the pound was overvalued, that Britain would struggle to maintain this parity. But the government under Prime Minister John Major, who had replaced Thatcher in November 1990, insisted that Britain would defend the pound at all costs, that this was a matter of national credibility, that the ERM membership was permanent and non-negotiable. But here's the problem, and this is what George Soros understood better than almost anyone else. Britain's economy in 1992 was not in a position to maintain a strong pound. Britain was in recession, unemployment was rising, businesses were struggling, and what the economy needed was lower interest rates to stimulate growth, cheaper money to encourage borrowing and investment. But staying in the ERM meant matching German monetary policy, and Germany in 1992 was dealing with the aftermath of reunification, was pumping money into East Germany, was worried about inflation, and the Bundesbank was keeping interest rates high to prevent the German economy from overheating. So Britain was trapped, was being forced to keep interest rates high to defend the pound's value, when every domestic consideration said rates should be cut, was pursuing a monetary policy that made sense for Germany, but was strangling the British economy. And this contradiction, this fundamental mismatch between what Britain's economy needed and what the ERM required, was obvious to anyone who looked closely at the numbers. And George Soros looked very closely at the numbers. Now, let me tell you about George Soros, because understanding the man helps you understand the trade. Soros was born in Budapest in 1930, lived through the Nazi occupation of Hungary, survived by using forged documents and hiding his Jewish identity, and this experience, this childhood spent navigating between truth and lies, between survival and destruction, gave him a particular worldview, a deep understanding that official narratives are often wrong, that governments lie or delude themselves, that survival depends on seeing reality as it is, rather than as authorities claim it to be. After the war, Soros escaped communist Hungary, made his way to England, studied at the London School of Economics, where he became fascinated by philosophy and economics, particularly the work of Karl Popper, and the concept of reflexivity, the idea that participants in markets don't just observe reality, they shape reality through their observations and actions, that markets are fundamentally different from natural sciences because in markets, the act of prediction changes the outcome. And this philosophical framework would later inform Soros's trading strategy in profound ways. Soros moved to New York in 1956, worked at various investment firms, and in 1970 founded his own hedge fund, initially called the Quantum Fund, and he built this fund using a particular approach that combined macroeconomic analysis with an understanding of market psychology. He didn't focus on individual stocks or companies. He focused on massive global trends, on currency movements, on interest rate policies, on geopolitical developments. and he looked for situations where official policy was in conflict with economic reality, where governments were making promises they couldn't keep, where the gap between perception and reality was so large that when it finally snapped, the market movement would be explosive, and he would position the fund to profit from that snap. And by 1992, Soros had a track record spanning more than 2 decades, had made his investors extraordinarily wealthy, had survived crashes and crises, and was managing billions of dollars. And when he looked at Britain's situation in the ERM, he saw exactly the kind of opportunity he specialized in: a government making an unsustainable promise, an official narrative that contradicted economic reality, and a situation where the inevitable collapse would create massive profit opportunities for anyone positioned correctly. The analysis that Soros and his team conducted in 1992 was straightforward, almost brutally simple. Britain was trying to maintain the pound at 2.95 Deutschmarks, but to do this required keeping interest rates high enough to attract capital into Britain and make people want to hold pounds. But Britain's economy was weak, and getting weaker. Unemployment was rising. The housing market was collapsing, businesses were closing, and public pressure was building on the government to cut interest rates and stimulate the economy. Meanwhile, Germany was keeping rates high and showing no signs of cutting them. So Britain was caught, couldn't cut rates without the pound falling out of the ERM bands, couldn't keep rates high without deepening the recession. And Soros asked the crucial question: how long can this continue? How much pain will the British government be willing to inflict on its own citizens to defend an arbitrary exchange rate? And more importantly, does Britain have enough foreign currency reserves to defend the pound if speculators start attacking it? Because here's how currency defense works. If speculators start selling pounds, if they start betting that the pound will fall, the government has to buy pounds to support the price. And to buy pounds, they need to sell foreign currencies, specifically Deutschmarks, and Britain's foreign currency reserves, while substantial, were not infinite. And Soros calculated that if enough capital attacked the pound simultaneously, if enough hedge funds and banks and institutional investors all decided to sell pounds at the same time, Britain would run out of reserves, would be unable to continue buying pounds, and the currency would collapse. And once Soros had this analysis, once he was convinced that Britain's position was mathematically unsustainable, he began building his position, began shorting the pound, meaning he borrowed pounds and sold them with the intention of buying them back later at a lower price. And he did this not with millions, but with billions. The final position was approximately $10 billion worth of pound sterling sold short, a bet so massive that it was larger than many countries' entire GDP, a position so large that it couldn't be unwound quickly. If Soros was wrong, if the pound didn't fall, the losses would be catastrophic, would potentially destroy his fund. But Soros wasn't wrong, had never been more certain of anything in his career. But Soros wasn't alone, and this is crucial to understanding how Black Wednesday unfolded, because Soros wasn't the only person who had done the math. Other hedge funds had reached the same conclusion. Other traders had seen the same unsustainable contradictions. And throughout the summer of 1992, pressure on the pound was building. It kept falling toward the bottom of its ERM band. And the Bank of England kept having to intervene, kept having to spend reserves buying pounds to push it back up. And each intervention was a signal to the market that Britain was struggling, was burning through reserves, was getting weaker, and like sharks smelling blood, more and more speculators joined the attack, and by September the situation was reaching a crisis point. The pound was constantly at the bottom of its band. Britain was spending billions defending it, and rumors were circulating that Britain would have to either devalue within the ERM or leave entirely. September 16th, 1992, Black Wednesday, started early in the morning with the pound under severe pressure. Soros and other speculators were selling pounds in enormous quantities, billions and billions of pounds flooding the market, and the Bank of England was spending foreign currency reserves desperately trying to absorb this selling pressure, trying to push the pound back up. And at first it seemed like maybe Britain could hold, maybe the reserves were enough, maybe the speculators would back down. But Soros didn't back down, kept selling, kept pushing, and other hedge funds followed his lead. And by mid-morning, it was clear that Britain was losing. The reserves were depleting. The pound kept falling, and the government made a desperate move. Announced that interest rates would be raised from 10% to 12%, a massive increase intended to make pounds more attractive, to stem the selling, and for a moment it worked. The pound stabilized. Some speculators got nervous, started to wonder if maybe they had miscalculated, but Soros looked at the numbers and realized that even 12% wasn't enough, that the economic damage from 12% rates would be so severe that Britain couldn't possibly maintain them. And he kept selling. And within hours, it was clear he was right. The 12% rate increase didn't hold the pound. It kept falling, and the government made another desperate move. Announced rates would rise again to 15%, an unprecedented level. A rate so high that it would have absolutely devastated the British economy if maintained for any length of time. Mortgages would have become unaffordable. Businesses would have collapsed. The recession would have turned into a depression. And everyone knew this. Everyone knew that 15% was unsustainable, was a bluff, was the government screaming at the market to back off. But the market didn't back off. The market knew the government was beaten. By early afternoon on September 16th, it was over. The British government announced that Britain was suspending its membership in the ERM, effectively admitting defeat, admitting that it could not defend the pound, that the speculators had won, that George Soros and the market had beaten the Bank of England, and the pound immediately fell approximately 15% against the Deutsche Mark, and fell further against other currencies, and Soros and the other hedge funds who had shorted the pound made enormous profits. Soros personally, through his quantum fund, made approximately $1 billion in a single day, $1 billion, and his investors made billions more, and across London and across Britain there was shock, humiliation, rage. The government had promised it would defend the pound. The Prime Minister had staked his credibility on staying in the ERM. The Chancellor of the Exchequer had insisted Britain would never devalue. And all of those promises had been proven worthless in a single day of trading, had been crushed by the combined force of hedge funds and speculators who had correctly calculated that Britain's promises were mathematically impossible to keep. The political fallout from Black Wednesday was immediate and severe. Prime Minister John Major's government never recovered. His approval ratings collapsed. The Conservative Party became associated with economic incompetence. And while Major managed to hold on to power until 1997, his government was essentially finished as a political force from September 16th onwards. The Chancellor of the Exchequer, Norman Lamont, became a figure of ridicule, was eventually forced to resign, and the ERM itself was exposed as fundamentally flawed. If even a wealthy and powerful country like Britain couldn't maintain the system, what hope did smaller countries have? And within months, the ERM bans were widened so much that they became essentially meaningless. And the entire project of monetary integration had to be rethought. And ironically, perversely, Black Wednesday probably saved Britain from an even worse fate, because if Britain had stayed in the ERM, had eventually joined the euro when it was created in 1999, Britain would have been locked into a currency system that proved disastrous during the 2008 financial crisis and the subsequent European debt crisis. Countries like Greece and Spain and Ireland suffered terribly because they couldn't devalue their currencies, were trapped in the euro, but Britain, having been forced out in 1992, maintained control of its currency, was able to respond to the 2008 crisis with its own monetary policy. And many economists now argue that Black Wednesday, while humiliating, was actually economically beneficial for Britain in the long run. But the immediate reaction in 1992 was not gratitude toward Soros. It was fury. British newspapers ran headlines calling him a monster, a vulture, an economic terrorist. Politicians gave speeches condemning currency, speculation, calling for regulations to prevent hedge funds from attacking national currencies. And Soros became public enemy number one in Britain, the man who had humiliated the nation, who had profited from British suffering, who had demonstrated that Britain was no longer powerful enough to control its own destiny. And there were serious discussions about whether what Soros had done should be illegal, whether currency speculation on this scale should be banned, whether hedge funds should be restricted from taking positions large enough to move markets. And Soros responded to these criticisms with remarkable candor, didn't apologize, didn't express regret, instead argued that he had done nothing wrong, that if Britain's policy was unsustainable, then it was going to collapse anyway, that he had simply recognized this reality before others did, that blaming him for Britain's economic problems was like blaming a doctor for diagnosing a disease, rather than blaming the disease itself. And he argued that the real villains were the British politicians who had put Britain into the ERM at an overvalued exchange rate, who had made promises they couldn't keep, who had pursued policies that were in conflict with economic reality. And here's where the moral ambiguity of Soros's trade becomes interesting, because both perspectives have validity. On one hand, Soros was absolutely right that Britain's ERM membership was unsustainable, the economic contradictions were real, the exchange rate was overvalued, and attempting to maintain it was causing real harm to the British economy. High interest rates were destroying businesses, increasing unemployment, causing mortgage defaults, and the longer Britain stayed in the ERM, the worse this damage would become. So in a sense, Soros was doing Britain a favor by forcing an exit, by making it impossible for politicians to continue pursuing a destructive policy out of pride or political calculation. Black Wednesday was painful, but it freed Britain from a system that was strangling its economy. And indeed, the British economy began recovering almost immediately after exiting the ERM. Interest rates could be cut, monetary policy could be adjusted to British conditions rather than German conditions. And within a few years, Britain was experiencing strong growth. So from this perspective, Soros was a kind of economic hero, someone who exposed the truth and forced necessary change. But on the other hand, and this is the perspective that many British citizens held and still hold, Soros made $1 billion in one day by attacking his nation's currency, profited from a crisis that caused real suffering for millions of people. The collapse of the pound meant higher import prices, meant inflation, meant that ordinary people's savings were worth less, meant that foreign holidays became more expensive, meant that the psychological blow of national humiliation. And Soros did this not out of any altruistic desire to help Britain fix its economic policy, but out of pure profit motive. He saw an opportunity to make money, and he took it, and the fact that his actions might have ultimately been beneficial doesn't change the fact that he was motivated by personal gain rather than public good. And there's something morally uncomfortable about one person making $1 billion in a day while millions of others suffer economic pain, even if that pain would have come anyway. And this discomfort is compounded by the power dynamic. Soros was able to do this because he controlled billions of dollars, because he had resources that gave him the power to attack a national currency. And there's something fundamentally undemocratic about one unelected individual having that much power, being able to override the decisions of elected governments, being able to force political and economic changes through financial pressure rather than through democratic processes. This tension between the economic efficiency of markets and the democratic legitimacy of governments is one of the fundamental questions raised by Black Wednesday, and it's a question we still haven't resolved. In a globalized world with free capital flows, do governments actually have sovereignty over their economic policy, or are they ultimately constrained by what markets will tolerate? Can a government pursue policies that markets consider irrational or unsustainable, or will speculators like Soros inevitably punish them? And if markets have that much power, if one person with enough capital can override government policy, what does that mean for democracy? What does it mean for the ability of citizens to choose their own economic destiny through voting? And these aren't abstract questions. They've become more relevant with each passing year. The Asian financial crisis of 1997, the Argentine peso collapse of 2001, the European debt crisis of 2010 to 2012, the Brexit currency volatility. All of these events raised the same fundamental issue that Black Wednesday raised, which is the question of power, of who actually controls economic policy in a world where capital flows freely and hedge funds can move billions of dollars with a phone call. Soros himself has engaged with these questions in his writings, has developed a sophisticated philosophical framework for understanding financial markets based on his concept of reflexivity, the idea that markets are not simply passive observers of economic reality, but active participants in creating that reality, that there's a feedback loop between market prices and economic fundamentals, that speculation can be self-fulfilling, that if enough people believe a currency will fall and act on that belief, the currency will fall regardless of the underlying fundamentals. And this creates a strange paradox where markets can be simultaneously rational in the sense that they eventually expose unsustainable policies, but also destabilizing in the sense that they can create crises that might not have occurred otherwise. And Soros argues that this is why financial markets need regulation, need circuit breakers, and controls and oversight, not to prevent legitimate price discovery, but to prevent purely destructive speculation that serves no economic purpose. And this is coming from someone who made his fortune through speculation, who personally executed the largest speculative currency attack in history. So, when Soros argues for financial regulation, it's not from a position of ignorance about how markets work, but from deep knowledge of how they can malfunction. The technical execution of the Black Wednesday trade is itself fascinating and worth understanding, because Soros wasn't just betting that the pound would fall. He was using leverage to amplify his position, was borrowing money to short more pounds than he actually had capital for, was using derivatives and forward contracts and options to create a position that would profit massively from a pound devaluation. And the quantum fund didn't just short the pound. It also went long on other currencies that would benefit from a pound collapse, went long on the Deutsche Mark, went long on the French franc, created a portfolio of positions that would all move in the same direction if the ERM crisis exploded. And this is sophisticated risk management, is not just making one big bet, but creating multiple correlated positions that reinforce each other, that hedge certain risks while amplifying others. And the team executing this trade wasn't just Soros, but included Stanley Druckenmiller, who was the lead portfolio manager, and a group of traders and analysts who spent months preparing for this moment, analyzing the data, calculating the probabilities, determining position sizes. And when September 16th came, they executed flawlessly. Didn't panic when the initial interest rate rise happened. Didn't get shaken out by volatility, just kept selling pounds with mechanical precision until Britain broke. The aftermath of Black Wednesday saw Soros achieve a level of fame and notoriety that few hedge fund managers ever experience. He became a household name, was featured on magazine covers, was both celebrated and vilified in popular culture, and he used this platform in interesting ways. Didn't just retreat to enjoy his wealth, but became increasingly involved in philanthropy and political activism, founded the Open Society Foundations, which spend billions of dollars supporting democratic movements and human rights causes around the world, became a major donor to progressive political causes, wrote books about financial markets and political philosophy, and in many ways tried to use his wealth in ways that addressed some of the concerns that his trading career raised. If he had made money by exposing the failures of governments and the brutality of markets, he would spend that money trying to make governments better and markets more fair. And whether you think this absolves him or not, whether you see this as genuine commitment to social justice or as an attempt to buy moral redemption, it's undeniable that Soros has been one of the most politically engaged billionaires of the modern era. But the legend of Black Wednesday itself has only grown over time. It's taught in every finance program. Every economics class is studied as a case study in currency crises, in market psychology, in government policy failures, in the mechanics of speculation. And every young trader, every aspiring hedge fund manager, every finance student learns about the day George Soros broke the Bank of England. And the lesson they take from it varies. Some learn about the importance of independent analysis, of doing your own research rather than trusting official narratives. Some learn about the power of conviction, of having the courage to make big bets when you believe you're right. Some learn about the mechanics of currency markets and how government intervention can fail. Some learn about risk management and position sizing. And some learn the darker lesson, which is that in financial markets, the big players can destroy smaller players, that capital is power, that if you have enough money, you can move markets, can attack countries, can override democratic decisions. And this lesson, this knowledge that markets are not level playing fields but are dominated by large institutions and wealthy individuals, is both empowering and disturbing. Empowering if you aspire to be one of those powerful players, disturbing if you're concerned about equality and democracy. The comparisons between what Soros did and what the Ghost did are interesting. Both made legendary trades. Both profited from seeing what others missed. Both demonstrated that independent analysis can beat consensus. But the differences are equally significant. Soros was operating in the open. His identity was known. His fund was established. He had institutional credibility. And after his trade succeeded, he engaged with the controversy, defended his actions, used his platform to advance ideas about markets and society, whereas the Ghost was anonymous, unknown, vanished after the trade, never engaged with the discussion, never defended or explained. And these different approaches reflect different philosophies. Soros believes in the power of ideas, in engaging with society, in using wealth to advance causes, believes that success creates obligations and opportunities to shape the world, whereas the Ghost apparently believes in privacy, in anonymity, in taking the money and disappearing, in not engaging with the systems that created the opportunity. And neither approach is necessarily better than the other. They're just different answers to the question of what you do after you've beaten the market in a spectacular way. The geopolitical implications of Black Wednesday extended far beyond Britain's borders. It changed the entire trajectory of European integration, demonstrated that the path to monetary union was going to be far more difficult than politicians had assumed, forced a complete rethinking of the ERM system, and ultimately contributed to the design of the euro. Because when the euro was finally created in 1999, the architects of the system had learned from Black Wednesday, had built in mechanisms to prevent speculative attacks, had created a truly unified currency rather than a system of fixed exchange rates, had eliminated the possibility of individual countries devaluing, and whether this was the right lesson to learn is debatable, because the euro has created its own set of problems, has trapped countries in a currency system they can't escape, has created massive imbalances between Northern and Southern Europe. But the point is that Black Wednesday fundamentally shaped how European monetary integration proceeded. And in that sense, Soros didn't just break the Bank of England, he changed the course of European history. And 30 years later, the debate about whether Soros was a hero or villain still continues. Still depends on your perspective, on whether you prioritize economic efficiency or democratic legitimacy, on whether you think markets should be allowed to punish unsustainable government policies, or whether governments should be protected from speculative attacks, on whether you admire bold individual action or fear the concentration of financial power. And there's no clear answer, no objective truth, just different values and different priorities. But what's undeniable is that Black Wednesday was one of the most important financial events of the late 20th century. That George Soros's trade was technically brilliant and enormously profitable, that it exposed fundamental tensions in the global financial system that we still haven't resolved, and that the story of one man betting $10 billion against an entire country and winning is the kind of legend that will be told for generations, not because it's morally simple or politically uncomplicated, but precisely because it's morally ambiguous and politically controversial, because it raises questions we can't easily answer, because it demonstrates truths about power and money and democracy that make us uncomfortable. So the next time you hear about a currency crisis, about a government defending its exchange rate, about speculators attacking a national currency, remember Black Wednesday? Remember George Soros selling £10 billion of pounds? Remember Britain raising interest rates to 15% in a desperate attempt to hold the line? Remember the humiliation of defeat? Remember the $1 billion of profit? Remember that markets can be more powerful than governments? That one person with enough capital and enough conviction can override the decisions of elected officials, can force economic policy changes, can make a fortune while a nation suffers. And ask yourself whether this is how the world should work, whether this is acceptable, whether the efficiency of markets is worth the cost to democratic sovereignty. And whatever answer you reach, whether you conclude that Soros was a hero who exposed an unsustainable policy or a villain who profited from national suffering, you'll understand something fundamental about the world we live in, which is that in modern finance, power belongs not to those who make the rules, but to those who have the capital and intelligence and courage to exploit the gaps between rules and reality, between official promises and mathematical truth, between what governments say they will do and what they actually can do. And George Soros, the man who broke the Bank of England, the man who made $1 billion in a day, remains the ultimate proof of this truth. remains the living legend of what one person can achieve when they see clearly, bet big, and refuse to back down, even when facing the combined power of a government and a central bank. And that legend, like the legend of the ghost, like all the great trading legends, persists because it represents something we simultaneously admire and fear: the triumph of individual intelligence over collective delusion, the victory of market reality over political fantasy, and the disturbing knowledge that sometimes the person who profits most from a crisis is the person who saw it coming and had the courage, or the ruthlessness, depending on your perspective, to bet everything on disaster.